So this is going to be one hell of a video because we're going to be looking at the most complex form of a weighted average cost of capital exam-like question. The reason why this is going to be the most complex form of the weighted average cost of capital type of question you may see is because we're going to be touching upon not only equity over value or debt over value, so the cost of equity and the cost of debt, but we're also going to touch upon the market value of preferred shares and the cost of preferred shares. However, to get there, we're going to take several different steps. And it's going to be a very comprehensive view of the most complex type of question you may see on WACC in an intro to finance course during your undergrad, or a refresher on finance during your master's or MBA. And even if you're trying to get a sense of how to get ready for a investment banking or private equity, or just a finance job in general, or even your CFA level 1. So in this video, we're going to do a few things, all right? And we can break it down into 3 different categories. The first category of things that we're going to do, or the first thing that we're going to do, is going to be walking through the weighted average cost of capital extended formula that includes equity, debt, and preferred shares. Once we've done that, I'm going to walk you through the different steps that you want to take in order to solve these questions confidently and earn top marks. I would definitely recommend taking this methodology and sticking it onto your formula sheet. Once we've done that and you comprehend the flow chart and the steps to take, we're going to move on to the third step or the third category within this video. We're going to be looking at 2 exam-like comprehensive questions that you may see on a very complex final exam or on a project or assessment. We're going to walk through those and you're really going to get a sense of every single thing that you need to do. So let's jump straight into it, all right? It's going to be a fun one. Get yourself some water, get yourself some coffee, even pause the video or make the video slower if I'm talking too fast or if I'm being annoying, all right? So let's go into the first category, the first segment of this video, and it's going to be a quick walkthrough of the weighted average cost of capital formula extended. All right. So the first thing to do is, let's try to understand this. Let's try to get a sense of what this formula really is all about. Now, if you've seen my other videos on the weighted average cost of capital, you're probably akin and used to the first portion of what we're seeing on the screen, all the way to DV, right? We had essentially cost of equity times equity over value plus cost of debt times 1 minus tax rate times debt over value. That's what we were used to. And really, this additional step or this extended formula rather, it only requires one additional step. And that step is quite easy, but it's important to remember. And it's important to have it onto your formula sheet because we're going to look at the cost of preferred shares. In other words, what is the required rate of return attached to preferred shares? And also, from the total entire value of the firm, well, what portion is allocated to our market value of preferred shares? So it's really the same idea, but we're just adding one added piece to our piece of the pie, right? Remember that pie that we divided between our equity and our debt? Well, now we're also injecting our preferred shares. Now, what I want you to be able to understand before we proceed is that our WACC will once again be divided into 3 segments, okay? And from this question, you'll be able to allocate essentially, well, how much does it cost us to deploy our own equity? Essentially, what do we require as a return for us to use our own money? Then we're going to look at the cost of debt. How much does it cost us to raise some debt financing? For example, what is the interest payment that we're going to have to pay on a loan, on a bond, or anything in between? Then we're going to look at our cost of preferred shares. Well, when we issue preferred shares, how much do we need to essentially compensate our investors? That's going to come at a cost, right? We're issuing shares, we're raising some money through equity financing, but in exchange, we have to pay them preferred shares. And preferred shares within the realm of our Intro to Finance class, and probably some of your major courses during your undergrad. We could call it something very similar to debt because it's an obligation before essentially your common shareholders. So that's a very quick run through within the first segment of this video of what the extended version of the weighted average cost of capital formula looks like. All right, we'll run through it one more time. Cost of equity multiplied by equity over value of the firm. In other words, market value of equity over the firm market value. Then once we've done that, we're going to add the cost of debt times 1 minus the tax rate times the market value of debt over the value of the firm. We're not done though. Now we need to move on to the last step of our extended WACC formula, in which we're going to take our cost of preferred shares multiplied by the market value of preferred shares divided by the value of the firm. Now, before we proceed to the second segment, I really want to stress the idea that this formula, really what it is, it's a weighted sum. We're trying to allocate essentially the actual proportion of our cost of capital that's allocated to equity, then debt, then preferred shares. And in order to find that, it's a simple multiplication. It's a little bit like what we did within our chapter on portfolio theory and our chapter on the capital asset pricing model, also known as CAPM. We're simply doing the weight of a specific portion of our firm value multiplied by the cost attached to that specific type of financing. Okay? So what we really need to do is we need to look at how do we find our cost of financing and how do we find the market value of that type of financing? How much did we actually raise for that type of financing? Because that's going to change essentially how we assess our cost of capital. So what I decided to do, now we're going to move on into the second category of elements. What I've decided to do is I decided to create a flowchart to make things a little bit easier for you to understand all of the different steps you need to take within the most comprehensive and complicated weighted average cost of capital question. And we could divide this, and we're actually going to look at it as well, but we could divide this into 3 categories, okay? And I'll zoom out a little bit so we see everything. So we could definitely divide this into 3 categories, right? Which is what we just mentioned within our WACC formula: equity, debt, and preferred shares. What I want you to understand is that preferred shares may not always be there, but in this video, we're going to assume that your most complicated question will include this. All right. So within these 3 different categories, equity, debt, and preferred shares, we're going to look at 2 different subcategories within each of them. We're going to be looking at how do we compute the market value? Then how do we compute the cost of that specific type of financing? When we're looking at how do we compute the market value of that specific type of financing, we're typically just going to do the number of shares or bonds outstanding multiplied by the price per share or the price per bond. All right. However, when we're solving for the price per share or for the price of bond, we're going to need to take a step back because we're going to have to utilize the formulas that we've learned and mastered within our equity valuation and bond valuation chapter. Notice that on the screen right now, we have a bunch of present value formulas on the right. You see our constant growth DDM formula right here and our just / dividend discount model here. We have our bond valuation formula right here. And then we have our par value times premium or discount formula. So that's how we're going to equip ourselves to find the price per share. Typically, by the way, these exam questions, we're always going to give you the number of shares outstanding. Now that we understand the first subcategory of essentially financing that we're going to look at, we need to look at the second subcategory, which is the cost of that type of financing. Now, there's going to be 3 costs, right? There's going to be 3 different types of costs, and it's going to require us to essentially use a specific formula every single time. Now that you have a general sense of what this flowchart is all about, I would like to kind of jump into them one by one. So let's begin with essentially our equity section, our first category. Now, as mentioned previously, within our equity section, we're going to look at 2 subcategories. The first one, the market value of equity, and the second one, the cost of equity. Let us begin with the market value of equity. In order for you to find the market value of equity, you're going to need to highlight 2 things. The first thing will be the number of shares outstanding. That's a walk in the park. That's easy. They're going to give you that in the question. The second thing they're going to need to highlight to solve for the market value of equity is to find the price per share. More often than not, for you to find the price per share within these complicated questions, you're going to have to do the following. You're going to have to use one of the 2 formulas here, either the constant growth DDM in order to solve for P0, or simply a perpetuity formula to solve for P0 if the dividend is constant with no growth. All right. This is something that we've seen in detail within our equity valuation chapter. And in this video, when we jump into the third segment, we're going to be looking at how we're going to equip ourselves with this. But this should be kind of straightforward still. All right. You just got to identify the different pieces of the question that talks about, growth or dividends or blah, blah, blah. Now, within the second subcategory of our equity section, which is the cost of equity, you're simply going to need to use one formula more often than not, if nothing else is provided. And that is going to be your CAPM formula in order to solve for the required rate of return of the firm. In other words, the cost of equity of the firm. And in order for you to do so, it's very simple. It's actually the simplest thing out there. It's simply the SML line, right? The risk-free rate plus beta times the market risk premium, which stands for the market return minus the risk-free rate. It's really as easy as that. Kind of a really walk in the park. And once you have these two buckets, you would be able to kind of like go back in our WACC formula and say, you know what? I have KE and I have E, but we still don't have V. V is going to come at the very end of our whole flow chart. All right. So now that we understand how to solve for the equity portion, let's move on to the second category of this flow chart, which is debt. Now, debt, once again, could also be divided into two sections, the market value of debt and the cost of debt. Let's begin with the market value of debt. The market value of debt, if you want to find it, it's very straightforward. You're going to take the number of bonds outstanding, so how many bonds were issued, multiplied by the price of the bond. Now, if the bond was not issued at par, in other words, $1,000, you're going to need to solve for the price of the bond. Now, this is bringing us back to our bond valuation chapter, in which we had our bond valuation formula. All right, let's do a quick walkthrough. Your bond valuation formula will require you to do the coupon, all right, divided by essentially the yield to market for that effective period. So let's say your yield to market here is 4%, but it's like an annual coupon. Well, KB is going to be 4%. If you have a semi-annual coupon, KB is going to be 2%. If you have a quarterly coupon, KB will be 1%. So notice how we have to divide it by frequency every single time. If you need like a refresher on the bond valuation formula, don't hesitate to watch my numerous videos on YouTube and to go on eastmahelps.com for an interactive lesson on what the heck is actually going on here. All right. So that said, then you're going to have 1 minus 1 over 1 plus KB to the power of n. N will not be the amount of years. It'll be the amount of years times number of payments per year. So if you have 10 years, right, left on the bond and you have annual payments, n will be equal to 10. If you have 4 coupon payments per year, then n will be equal to 40. Then we're going to have plus f, which is the face value, always 1,000 typically, divided by 1 plus KB to the power of n. And that's how you would find the present value of a bond. Very straightforward. It's literally what we looked at in our bond valuation formula chapter. Sorry about that. And it's really the easiest form of that. So once you're able to highlight your price per bond and you're able to figure out how many bonds are outstanding, you can multiply these two numbers together in order to solve for the total market value of debt. It's as simple as that. Once you have that, you're going to move on to solve for the cost of debt. Okay? The cost of debt is very interesting. You're always going to need to take your yield to market. Okay? In this example, we have 4%. However, that's not it, because we need to account for the number of compounding periods within the year. And the number of compounding periods within the year, for these types of questions, we're going to take it as being the number of payments within a year. In other words, the frequency. That's why we have F on our screen right here, F, right? So in YTM, A means the yield to market per year, the annualized yield to market. Now, with that said, this formula that you see here may be foreign to you, but it's actually another format or essentially another way of writing our effective periodic rate formula. All that we're doing is we're taking our yield to market, we're dividing it by the frequency. So if it's 4% with 2 payments per year, you'd have 2%. And then you're going to put that to the power of 2 to find your actual effective cost of debt per year, because we need to take into consideration the number of compounding periods per year. This is whole idea of the opportunity cost, okay? And that's how you would solve for the cost of debt. Don't you worry. we're going to do this together for 2 exam-like questions. So you're going to have a lot of exposure. Now that we're done with that, we can move on into the last category of our market value for the firm, and that's going to be preferred shares. Now, quick caveat before we proceed. Preferred shares aren't always included. However, the most extensive question will include that. And I want you to be prepared and I want you to understand how to solve for them. And it's actually quite easy. So once again, preferred shares can be divided into 2 segments. 1, how do we find the market value of preferred shares? And then 2, how do we find the cost of issuing preferred shares? What does that mean for us in the business? Let's begin with the first section, which is the market value of preferred shares. If we look at the market value of preferred shares, it's simple still. You take the number of shares outstanding multiplied by the price per share. In other words, the price per preferred share, not the price per common share. Very important to make that distinction because like that, you're going to have a mistake and we don't want that. So how do we find the price per preferred share? It's very, very straightforward. On the exam, they may ask you to either do one of 2 things. They may ask you to use this formula right here, in which you're going to do essentially, I can't even use my brain right now, but let's say we move that. It'll be DPS over K, and that's going to give you the price of the preferred share. So we're just using our perpetuity formula. Or if that's not the case and they issue a question at which preferred shares are being traded at a premium or a discount at their par value, all that you have to do is use the following formula, okay? The present value, so the price per preferred share, will be equal to the par value times the premium on the share or the discount on the share. A question will typically note this as being, hey, preferred shares are trading at a 10% premium or 110% premium, and so on and so forth. So that's how you would find your price per preferred share. Once you have your price per preferred share, what are you going to do? Well, you're going to take that price, you're going to take that amount, and you're going to multiply it by your number of preferred shares outstanding. And that's going to give you your market value of preferred shares. Now we're happy. We get to move on to the second category here within our preferred share section. And that's going to be, how do we find the cost of preferred shares? What you're going to do is straightforward, okay? You're going to take your dividend payment, okay, for preferred shares divided by the current price of preferred shares, all right? And that's going to give you your required rate of return on preferred shares and give you your cost on preferred shares. And that's how you solve for these. If that's not too clear for you just yet, don't worry, because we're going to be looking at an example, actually 2 examples at which we're going to have different dynamics, different gymnastics for our preferred share section. And it's going to give you a lot of exposure there. So let's take a step back. We just walked through the 3 different stages of our essentially comprehensive WACC questions: equity, debt, and preferred shares. And I want you to understand that we're going to always break it down into 2 sections. How do we compute the market value of one of those topics? And how do we compute the cost of financing for one of those topics? All right, it's as easy as that. I would definitely recommend that you use this flowchart when you practice for these questions, that you add this flowchart to your cheat sheet if you're allowed to have one on your exam. And I would also maybe recommend that you try to write this down yourself such that you understand the steps allocated towards these complicated WACC questions for your exams, for your assessments, and for your projects. There's a reason why we're using all of these, right? We're not going to go too much in detail on them because we want to be efficient. We want to start walking through questions together, but still, it's a very good exercise to have when solving for exam-like problems and to understand the material at play. So now that we finished the second segment of our question, or of our video, sorry, we get to move on to solving exam-like questions. And how do we, 1, identify the material? How do we highlight the right things? How do we look for the right elements? And then how do we just compute for them by using a flowchart? Really as easy as that. And that's going to give us the opportunity to solve for the long, elongated version of WACC. In this video, we're going to be looking at 2 exam-like questions. The first one, we're going to walk through it step by step. We're going to solve these things together. The second one, we're going to kind of sprint through it, assuming that you've had the exposure needed, but still need like another perspective on these types of questions, such that you could learn in a non-static way. So sorry about that. We can now move on to solving our first exam-like question, and we're really going to highlight everything step by step. Alrighty. Sorry about that. I had to crack my neck a little bit. I've been doing like 7 or 10 videos today, so it's getting a little bit much. So what we're going to do here, because we want to make this like kind of comprehensive, we're going to use our formula in all the different colors to color code this question and kind of move on this question step by step together. So as we proceed, I'm going to highlight things and be like, oh, a bell should be ringing for you here. If you read this question, this is what we're going to use for the equity section, or this is what we're going to use for the debt section, and so on. So let's go ahead and do this together. So Shy Designs has been publicly listed on the Toronto Stock Exchange for a few years. The firm's common stock has 0.95 million shares outstanding with a book value of $35 per share that regularly pays a dividend to its shareholders. So let's take a step back for this specific sentence. We got a few interesting things here, all right? So let's go ahead and take out our red highlighter. Let's highlight that there are 0.95 million shares outstanding, okay? That's very important for us. However, what I want you to also be able to identify is that, well, the book value per share, that doesn't do anything for us. The reason why it doesn't do anything for us is because we want to take the price per share that's like currently trading, not the book value. Because the book value, essentially what it is, it's the initial, all right, is the initial issuance price for those common shares when there was an IPO back in the days. Well, maybe the stock is trading at a higher price. Maybe the stock is trading at a lower price, okay? That's why it's important to actually use our equity valuation formulas to solve for the present value of these stocks, of these common shares. And also, if you're on an exam, and you'll see in the next sentence, if they give you a bunch of information, right, that's related to a specific chapter and that's related to a specific formula, you want to have the presence of mind to understand that, you know what, maybe I want to plug these things in, right, because it's helpful. That's exactly what we did back in the day. So hopefully that's clear. So for us, whoa, this is a little bit too big. Anyways, we're not gonna, this is a kid's show. You gotta stop saying nonsense. So we're not gonna take this into consideration. All right, let's move on to the next sentence. Note that Shy Designs just paid a 1.6 annual dividend, okay? And the CEO mentioned that it is expected to grow at a rate of 3.5% per year indefinitely. Now there's a lot of good stuff in this sentence, and let's go ahead and highlight them together. So number one, they told you that they just paid a dividend for $1.6 per share. That's extremely relevant because this is what we're going to call D0, all right? Extremely relevant. And then we're going to try to find these things in our formulas there. Then they also told you that, well, the dividend is expected to grow at 3.5% per year, okay? Forever, indefinitely. So in other words, you could set your G as being 3.5%. So let's go ahead and write that, 3.5%. Oh, man. All right. So now that we have that, we can move on to more of this problem together. Notice how we're just making sense of things, okay? We're just working through this together. And let's even erase more of the fluff. Like we just care about the stuff that we highlight. The rest doesn't matter to us. Now, if we move on to the next sentence, they're telling you that, hey, the common stock, okay, their common stock has a beta of 1.65, while the standard deviation on the market portfolio trends towards 10.45%, while its annualized returns yields 10.5%. So let's walk through the noise here. Let's highlight what's relevant. They just told you that the beta, all right, of the common stock is equal to 1.65. And that's extremely important. Why is it extremely important? It's because if you look at your flowchart, you know that if we want to solve for the cost of equity, we need our beta. And in this case, they gave you the beta. All right, so we could go ahead and say, you know what, beta is important. Beta is equal to 1.65. I really want to have that in mind. Then they're letting you know that the standard deviation of the market portfolio trends towards 10.45%. Now, if this is the first time you're doing a question like this, you need to go back to your formula, okay, for your cost of equity, and you say, I don't care about this because within my cost of equity formula, I don't see sigma. I don't see the standard deviation anywhere. So we don't got to use that, all right? So let's not use that right there. We could just put that as being no bueno for us. You go ahead and remove this. It's just noise that we don't need. However, they also let you know that the annualized returns on the market portfolio is 10.5%. That's important for us. The annualized returns of the market portfolio, all right, is 10.5%. And if we go back to our flowchart, hey, ERM's right there. We need that. Okay, so let's go ahead and highlight this as being equal to 10.5%. They're also letting you know in the next sentence that, well, maybe you want to note that the risk-free rate of return is 2.8%. That's okay. Let's go with that. That's very important to us because we know that that also stems within our CAPM formula. So far, so good. We're having a good time. 2.8%. All right. Now, if we read the next sentence, let's read it together. You'll see why I said uh-oh. Also, the firm has 0.5 million preferred shares outstanding with a face value of $100. Now we could go ahead and take another color because now we're talking about preferred shares. So let's go ahead and highlight the stuff that we need here in a different color. So we have 0.5 million preferred shares outstanding. And the reason why that's important, if we go back to our little flowchart, is because we know that if we want to solve, okay, we're right here. If we want to solve for a market value of preferred shares, well, we need the number of preferred shares outstanding. In this question, they gave you exactly that number. And they also gave you what the par value / face value is. It's $100 here. Amazing stuff, amazing stuff. So you can go ahead and highlight that as well. So we got, I'm not going to highlight that part because it's not like a symbol or anything, but our face value, so we're going to call this our par value. All right. Now, surprisingly, if we read the next sentence, preferred shares are trading at 92%, while the preferred rate trends towards 5%. That's very interesting. We know that the premium here, or the discount on preferred shares, well, it's at 92%. So here we could write discount, and we're going to use that to find the present value, so the price of those preferred shares. And they're also letting you know that the preferred rate is 5%. Now, what is the preferred rate? The preferred rate, essentially, call it R, is going to help us to solve for the dividend on preferred shares. And the dividend on preferred shares, which is what we have right here, it's equal to the face value or the par value, you could call them the same thing, times the preferred rate. Let's do some quick math. $100 times 5%, we get $5. That's going to be your dividend on preferred shares, okay? So now let's read the next sentence. They're telling you, however, Shy Design's capital structure holds traditional long-term debt in the form of 10-year quarterly coupon bonds with a face value of $1,000, which were issued this year. A lot of stuff here in this sentence, but let's take our time and let's highlight this in orange and let's try to make sense of what has been shared with us. Let's get it. Let's go into this. So in this case, we know that there's also some long-term debt, okay, in the form of a 10-year quarterly coupon bond. Quarterly coupon, I guess I should go with quarterly coupon bond with a face value of $1,000. And they were issued this year. So there's a lot of stuff, okay? Well, let's kind of make sense of this. The reason why this is important is because we know that we have 10-year quarterly coupon bonds that were issued this year. So they weren't issued 10 years ago or 5 years ago or 3 years ago, they were issued now. The reason why that's important is because when we calculate our N, we will know that, okay, our N is equal to the amount of years multiplied by the frequency. And the frequency stands for the number of payments within a year. And in this case, if somebody were to buy these bonds, they would have 10 years worth of bonds and 4 payments per year, such that if we take these two into consideration, we would say, well, N is equal to years times frequency. And that would be 10 times 4. and that's 40. And the reason why we're going to let our N remain at 40, it's because we understand that anybody who buys the bond right now, if we read the question, they're going to benefit from all of those 40 payments. So that's amazing news. Now we also get our face value at $1,000. So that's going to be F equals 1,000. And we also know that once again, the bond was issued this year. So that's a bunch of really good information. Let's go ahead and read the next sentence. The firm issued 100,000 bonds with a coupon rate of 8%, while the annualized yield to market, so the annual yield to market, is 4%. Let's make sense of this sentence together. So the reason why 100,000 bonds is relevant to us is because we know if we go into our flowchart and we look at the market value of debt, we know that the number of bonds issued or outstanding is crucial, okay? In this case, we need that because we want to solve for the market value of debt. They also told you that the coupon rate is equal to 8%. The reason why this is relevant is because with that, we're going to be able to solve for a coupon, all right? Our coupon payment. And don't forget that your coupon payment is the coupon rate multiplied by the face value, all right, divided by the number of payments in a year. So your coupon in this case, all right, if you do some quick math, it'll be 1,000 times 80. That's going to give you $80, all right? Divided by 4, it's going to give you a coupon of 20 bucks. I hope that's clear for everybody. It's going to give you a coupon of 20 bucks. And if we look at the annualized yield to market, so in other words, the YTM, and they're telling you it's 4%, well, that's important because we know that we can now get our KB, which is what we need for a valuation formula, right? Right here, KB. However, KB, it's not 4% here. KB will be equal to 4 divided by the frequency. There are 4 payments per year such that your KB will be 1%. And of course, our YTM is also very important for us to be able to solve for our cost of debt, which is what we're going to use here. So we're going to do 4% divided by 4 plus 1 to the power of 4 minus 1 to get our effective annual cost of debt. That's how I'd like to call it. So now that we have that, we can now move on to just the last sentence, which is simple. We don't even need to highlight this in a specific color. We can put this in yellow. We know that the corporate tax rate is equal to 28%. Amazing stuff. You need that for your formula on WACC. Then we're also going to highlight the mission of this question, which is, I mean, at this point, pretty obvious. But it's going to be to calculate the firm's WACC. All right? So now that we walk through the question and you literally have everything that you need to solve this, we're going to walk through the flowchart one by one. We're going to start with equity. We're going to solve for the market value of equity and the cost of equity. Then we're going to go into debt. We're going to solve for the market value of debt, and then we're going to solve for the cost of debt. And finally, we're going to go into preferred shares, and we're going to solve for the market value of preferred shares and the cost of preferred shares. Once we have all of this information, we'll be able to solve for the total value of the firm, right? Because we're going to add equity plus debt plus preferred shares, right? Their market value. That's going to give you the value of the firm. Once you have that, now magic happens because we'll be able to find the proportion of equity to value, the proportion of debt to value, and the proportion of preferred shares to value. And with that, we'll be able to plug in all of the information within our WACC formula and get our answer. It's really as beautiful as that. All right, so let's go ahead and move to the first step, all right, which is solving for all of the equity portion. So as you can see, I already have some inputs here, but we're going to work through it together. What I'd like to do is I guess I'm going to put this in a different color. I feel like we're zoomed in enough. Yeah, I mean, that's okay. Okay, so what I would like to say in this question is that they gave us the risk-free rate. They gave us a bunch of good stuff. All right. Now, what I'm going to do is I'm going to pop up the question myself such that we're able to work through it together. So let me just do that. It won't be too long. I'm just going to grab the question. Just like that, I can make sure that it's like we were working on it together type of thing. Cool. it's not as pretty, but we got what we need. So what's awesome here is we're going to start with finding our cost of equity, okay, our KE. It's going to be part 1 here. Now, what's awesome with our KE is that we literally already know what our risk-free rate is. We already know what our beta is, and we already know what our ERM and, of course, our risk-free rate is. So with that, we're going to be able to solve for KE, and we're going to do that together. Why not? So I could go ahead and kind of say, okay, we have our 2.8 for our risk-free rate. We have our beta of 1.65 on the common stock of Chai Designs. We have our ERM, which is 10.5, okay? And by definition, we would have our risk premium. So we could go ahead and plug this in within our formula. We would know that KE is going to be equal to 2.8% plus 1.65 times 7.7%. Now, this is my first time ever doing the question. So I'm going to be super transparent and we're going to work with it together. Now, it's my first time solving it without my problem creator that I have there. So that's what I mean by it's a little bit different. But I want us to work on this together such that you really have the most comprehensive view that you could get, okay? And in this case, when we plug this in within our formula, we would get that KE is going to be equal to 15.505%. Now you could round it up, it's really up to you. That's up to your discretion. So now that we have that, we could go ahead and identify that, yeah, okay, cool. We have our cost of equity. And you could even be as funny as myself and go ahead and say, okay, boom, we have our cost of equity. And by definition, low-key, we also have our tax rate. So we're just solving for these pieces one by one, all right? So now, in order for us to find the market value of equity, we need to know, okay, well, which formula are we going to use? If we go back to our question, we remember they gave us information that Chai Designs just paid a dividend. And that means that that's D0. In the question, our just paid dividend was equal to, if I could go grab it real quick, it was equal to 1.6. So we could go ahead and identify this, right? Our D0 as being 1.6. So we have that information. However, now what's really awesome is that we also have our K, which is our cost of equity. So we have that as well. And in the question, so I can maybe even erase this here, which is 15.505 or 15.51, so up to you. And in the question, they also gave us our growth rate. And the growth rate here is 3.5%, okay? So that's what we need as well, and we have that. If you read the question, remember how we highlighted things together, and it's 3.5%. So now all that we need to do is plug that in within our formula. So we know that the present value of our common shares will be equal to 1.6 times 1.035 over K minus G. So it's going to be 15.505% minus 3.5%. And that's going to give us a price of, now of course I already have the questions, but I like working it with you guys such that it kind of creates this feeling that you're doing this with someone. I guess that's my thesis on the whole thing. Maybe I'm totally off, but it's whatever, I'm here to help, so that's what matters to me. So we're gonna have 15, we're going to have 1.6 times 1.035 over 0.1505 minus 0.035. And that's going to give you a very interesting amount. Just going to make sure that it's okay. Am I on? Open. I'm just making sure that my answer is correct, but I seem to have something that's not working too well here. seem to have two different amounts. Now, I'm not sure if I'm doing some sort of weird stuff. So let's go ahead and work through this together. So we're going to have, that's so strange. Oh, we'll do this myself. I'm good. So we're going to have on our numerator 1.656. We're going to have on our denominator we're going to have essentially 12, whoops, 0.12005. If you do that, I don't know what I did before. Maybe I'm on some sort of dark magic, but the answer is what I had from the very beginning. I guess I just wanted to proofread my stuff, but no, your price per share is going to be equal to 13.79425. Curious why it didn't work before though. So that's exactly what I got here as well. It was funny because I'll be totally transparent. I was doing the question before, but for some reason, I guess I made a mistake while I was retranscribing my stuff. Ah, I know what I did. My bad. I'm just dyslexic. Yeah, I'm dyslexic. It's okay. But anyways, it's always better to be extremely diligent than to be a fool. In this case, I'm both. So now that we have our price per share, we could actually go ahead and find the market value, okay? Because we know that we have, in terms of number of shares outstanding, we have 0.95 million. So we have 950K. So we know that the market value of equity, okay, so we could call it equity, is going to be equal to 0.95 million multiplied by 13.79425. That's going to give you that equity. Okay, so if we go ahead and kind of erase this stuff, it's going to give you that the total value of equity for the firm. This one is you just got to plug it in within your calculator. It's going to give you 13,104,539. Okay, and that's going to be the value of equity of the firm. Now, if you do some quick math, that should make some sense. It's a little bit smaller than if you just did this times a million. So for me, my sense check works. Now on an exam, I would definitely recommend kind of keeping it as unrounded as possible. Try to keep your numbers whole. But for us, we're going to work with this. So now we have our equity value. We don't have equity over value of the firm, but we definitely do have our equity. So what I'm going to do, because I want us to at least have some sort of like short-term, dopamine, we're going to go ahead and do a little check mark on E. Okay. So now we're good. We can move on to our debt portion. And our debt portion, once again, what we're going to do is we're going to solve for our cost of debt. Then we're going to solve for our market value of debt. But in order for us to solve for our market value of debt, we're going to need to find the price per bond. All right. So let's begin with the first little beast that we have here, which is a little bit strange, because this doesn't seem like something that's, appealing, this little formula that we have. But there's actually a very easy rationale to have here. And I want you to remember this. Remember, under our time value of money chapter, we did the following to find an effective periodic rate, or an effective annual rate, really. What we did is we did this plus QR divided by M to the power of M minus 1. Well, in this case, if you're sharp, you can notice that this is the quoted rate. This is M, and this is M. And this is the effective annual rate. And that's exactly what we're trying to do here. We're trying to find the effective cost of debt. In this case, we know that the yield to maturity that was provided in the question was 4%. But the number of compounding periods, right? The way we're going to visualize this is the number of payments, okay? So the number of coupon payments. And in this exam question, we know that the number of coupon payments, well, it's equal to 4. Why is it equal to 4? Well, if you go back to the prompt, they let you know, hey, by the way, we got quarterly coupons. So we're making payments every essentially 3 months. So you could go ahead and say, well, we got these two values. Boom, just like that. That's amazing. So with that, we're going to be able to solve for our KD. It's going to be a walk in the park. So KD is going to be equal to 1.01, because we're taking 4 divided by 4, to the power of 4 minus 1. And that's going to give you, I could literally do it with y'all on my calculator. 1.01 power of 4 minus 1 times 100, because we want a percentage. We're going to get KD is equal to 4.06. That's so ugly. 0604. We just got our KD. It's literally as easy as that. All that we had to do is we had to use this formula to our advantage. Okay. So if you go ahead and go here, boom, we got the same answer. Look at that. Now we need to find the present value of our bond. And in order for us to do that, we got to go back in time and go look for our bond valuation formula. All right. And this is exactly that, our bond valuation formula. That's exactly what I highlighted here. Now, if we go back to our prompt, we've identified C, we've identified KB, we've identified all those good things. Let's go ahead and do it again. In the question, they told you that the face value of the bond is $1,000. So you know that the face value is equal to 1,000. That's super cool. We also know that the coupon, what is a coupon? Well, the coupon is going to be easy. It's going to be F times the coupon rate divided by the number of payments. In this case, we know that our face value is $1,000. And we know that our coupon rate in the question is 8%. So then you're going to do 1,000 times 8%, so you can get 80. Divided by the number of payments, which is 4, you're going to get 20. So we get 20 here. So we then have our C. And what about our yield to maturity? What about our KB? Well, yield to maturity is going to be easy as well. You're going to take your YTM, okay, and you're going to divide it by frequency, so your number of payments. In this case, you're going to have 4 divided by 4, well, 4% divided by 4, and you're going to get 1%. Okay. So in this case, we have our KB. And that's what we're going to plug in over here. So we're going to plug in over here. So we're going to plug in over here. Now, last but not least, is finding our number of periods. Our number of periods will be very straightforward. Our number of periods is simply number of years times the number of payments per year. And that will be 10 years times 4 payments per year, such that we get 40 as our N. So now we have our N as well. So we have all of the things that we need to solve for the present value of this bond. Look how everything here is exactly what we just identified. Okay, so we got 1,000, we got 20, we got 1%, and we got 40. It's amazing news. So we go ahead and just zoom out and zoom in. There you go. So to make this simple and to make this fun and interactive, we're going to go ahead and kind of do 2 things. We're going to break down this formula into 2 portions. We're going to have portion A, and we're going to have portion B. We're going to solve for A and B, and we're going to add them together, and that's going to be the price of our bond. That's usually how I used to break down these bond valuation formulas for my students within the bond valuation chapter. So let's go ahead and do that. Let's try to solve for A first. And A, essentially, will be, we're going to take our coupon, divided by 0.01, multiply, sorry, by 1 minus 1 over 1.01 to the power of 40. If we go ahead and plug that in within our formula, we should get something cute. I hope we do. It's always a game of hope in life. We're going to get 20, whoops, over 0.01 multiplied by 1 minus 1 over 1.01 to the power of 40. Now color me purple if I don't get this correct. Should be good. Cool. So you're going to get the following value. You're going to get 656. Sorry, I'm plugging this in my like a symbol lab just to make this easier for myself. You're going to get that 69372. And that's going to be for portion A. All right. Now we can do portion B. Portion B is mad easy. All that you're going to do is 1,000 over 1.01 to the power of 40. So in other words, you're just doing some simple discounting. And what you're going to do, if I just erase all these bad boys, you should be getting something, I don't know, like 200, 600, no. Yeah, that makes sense. Cool. So you're going to get 671.65313. 65313. Now what we're going to do here to find the price of the bond, we're just going to do A plus B. And that's going to give us, by the way, just to show you that I'm correct, we have these two amounts. And that's going to give us essentially here 1328.35. And that's going to be the price of our bond. Okay, so I guess I'll write this as being 0. Now, a quick piece of context for you. The reason why we have a bond that's trading at a higher price than our face value is because, well, the firm, in this case, I believe it's Shy Designs, it's paying a coupon rate that is higher than the market rate. And for that reason, people are more incentivized to get this get this bond, because they're going to get higher interest payments in comparison to other similar bonds in the market. A quick little reminder on what we did back in the days in our Intro to Financial Accounting course. So now that we have that, we are happy because we now have the price of the bond. And we know that we have in this question a bunch of bonds outstanding. If I'm not mistaken, it should be 100,000 bonds outstanding. Yes, it is. So what you're going to do is you're going to do 100,000 multiplied by 1.328.35, and that's going to give you debt. Not debt like dying, but debt like I'm cringe, but debt like the debt value. So we got a price of our bond. We're super stoked. We got 100,000 bonds. We know that it's the price, such that if you multiply these two numbers together, you're going to get the value of debt. And in this case, it's a poquito big amount. And we could say that we got 132.83466. Well, I'm so sorry. 0.11. And that's going to be our value for debt. Okay. And just like that, this is starting to get kind of fun, kind of easy, because we walk through these steps and we have all the tools already. I mean, we've done this the whole entire chapter. And I always like to do like a sense check as I'm going through this, but this definitely, we are in the right path and we have the right answers. So now we can move on into the last portion of the question, which is our preferred shares. So the first part for us, what I'd really like to work with, is kind of figuring out, well, what is the price, okay? What is the price of one individual preferred share? And in these types of questions that I gave you here is, well, what you're going to do is you're going to take the par value multiplied by the premium and or discount provided in the question. So if you recall, we know that we had, if I could go back really quickly to find, we had essentially $0.5 million in turn, I'm so sorry, 0.5 million shares outstanding, not bad. I'm getting a little bit tired. We're 54 minutes in, I'm getting a little bit weird. And we know that the face value is 100, okay? Now this is gonna help us to find the value of preferred shares, but what we really care about is the face value, and we know it's trading at a multiple of 92%, such that in order for you to find the present value of the bond, of preferred shares, all that you're gonna do is 100 times 92%. And this means that one individual preferred share is selling at 92 bucks. It's really as easy as that, okay? So we could go ahead and highlight this number right here, 92 bucks per preferred share. It's kind of a walk in the park. Now that you have that, we could go ahead and find, if you want, we'll skip a step and we'll go straight into finding the value of our preferred shares. Because we know we have 500,000 preferred shares outstanding, and we know that they're trading at $92 each, we could go ahead and find the value for preferred shares. And in this case, the value for preferred shares is equal to 92 times 500,000. Let me try to show my quick math skills, which I probably don't have. I'm going to say it's between 4.5 million. I'm going to say 4.6 million. 46 million. Damn, pretty bad. I don't know how to do my zeros. So we're going to have $46 million here. All right. Very easy math. I feel like anybody can have done that. I don't know what I'm trying to flex here. And then we're able to get our value of preferred shares of 46 million. Now it's a question of finding our required return on preferred shares, or the cost of issuing preferred shares. Well, we need to find DPS, and DPS is pretty straightforward because all that you got to do is you're going to take your par value multiplied by your preferred rate. That's going to give you $100 times, in this question, I believe it was 5%, such that your DPS is equal to $5. Look how easy that was. Then you're going to do $5 divided by $92. So you're going to get, I guess I'm going to try to find some space. Whatever, we'll be good with this. KP will be equal to $5 divided by 92. And that means that your KP, if we do some math together, equal to 5 divided by 92. That's going to give you 5.435. Am I on? Okay, my calculator, it likes to round up stuff. I was so scared. I was like, am I crazy? Am I not doing very well right now? So you're going to get a KP of 5.43478%. Now, if you could hear the music that I have playing in the background, I'm starting to get a little bit concerned because I don't know what's playing. It's getting weird. So with that, we could go ahead and kind of identify all the good stuff that we have. So now that we have our value for debt, our cost of debt, our value for preferred shares, and our cost of preferred shares, go back into our WACC formula at the top, and we could get that little instant gratitude, that little dopamine fix, because we could say that we have our cost of debt, we could say that we have D, we could say that we have KP, and we could say that we have P. So now we're pushing P, and we're able to find the value of the firm. The value of the firm, to make it super clear to y'all, it's going to be simply equal to E plus D plus P. So let's go ahead and highlight what is the value of the firm right now. So I guess I'm gonna write it right here. And we'll zoom in a little bit for now. So now that we have all of these values, we know that the value of the firm, if you add all the numbers that we had prior, is going to be equal to 191,939,226. That's going to be the value of the firm. And if you want some active recall, we did 46 mil plus 132 mil plus 13 mil. Okay, that's exactly what we did. If we zoom out a little bit, 46 million, 132 million, and where is it? It's at the top, 13 million. And that's going to give us our value of the firm. And with that, let's take some time to just highlight what our EV is, okay? Let's take some time to do just that. Whoops. Underscore. Oh, okay. So let's try to do that real quick, just to identify these pieces because they're important to us. So our EV, okay, which we'll highlight here in yellow. We could go ahead and call that being essentially 13 million over 191 million. If you do the math, okay, because I'm a little bit lazy now, you have the numbers. We did this together. You're going to get EV as being equal to 6.83%. Okay. If we go to do our debt over value, you're going to get 132 million of 834,686 approximately over 191,939,226. And that's going to give you essentially, if I were to maybe just put this here, you're going to get 69.21%. And finally, what you could do to find the preferred values, you could add 69.21 plus 6.83 and just find the remaining piece. Or you could just do the math, which would be 46 million over 191,939,226. And that's going to give you a preferred value over value of the firm of 23.97%. Now, note that I did round these answers a little bit, just to make this easy and quick and digestible. But I think you get it at this point. So you go ahead and highlight these in the colors that we've been using from the very beginning. So now that we have all this, let's go ahead and plug this in within our formula, and we're going to work through this step by step together, because why not, right? So look at that. We have everything that we need in front of us now. So just to make this an exercise that you could actually internalize and do with me as we go, I'm gonna drink some water before though, just because I've been talking for an hour now. So we could go ahead and do this. We're gonna go and identify colors. Why not? So our cost of equity, I'm gonna put it as 15.51%. We know that our equity to value is equal to 6.83%. We know that our cost of debt is going to be equal to 4.06%. For sure, I'm rounding it up, by the way. And our debt to value, or I guess our tax rate in this case, it's 28%. We need it for this. Our debt over value is going to be equal to 69.21%. So we have all of that good stuff. Then we could go and move on to our cost of preferred shares. We know that that's equal to 5.43%. By the way, I'm rounding it up, so please don't, kill me if I do this like this. And then our preferred value over the value of the firm is going to be equal to 23.97%. Okay. So what we're going to do is we're going to work as a team right now, and we're going to solve every single one of these one by one, and then we're going to add them up together, and we're going to find a WACC. Okay. I know that this was long. We're at 45 minutes almost. But on an exam, once you've identified these steps, or if they want you to do just one portion of these steps and then solve for WACC, you're going to be equipped. You're going to know what to do. So let's go ahead and do that. So for the first portion, cost of equity times the equity value over the value of the firm, you're going to get something really interesting. You're going to get a very small amount. And the reason why you're going to get a small amount is because the prorated cost of equity is going to be much smaller, since only 6% of the firm is being raised through equity. You're going to get a number that I'm going to round up as being the following. All right. Now let's go on and solve for the cost of debt. Cost of debt is going to be a walk in the park. All that you're going to do, you have 4.06, 1 minus 0.28 over 6 times 69.21. You're going to get a cool amount. You're going to get 2, and I don't need to round this one up too much there. 2.0231467.2%. Okay, so that's going to be for your cost of debt. Now we can go ahead and look at our costs for preferred shares, our prorated cost for preferred shares, if I were to be more strenuous. And we're going to have the following, 5.43%. Now, by the way, I already have all these answers. I just want to make this interactive. I've been saying that probably twice now, but it makes it more fun. You get to work with me. You get to have some context. You get to see how I solve this without just plugging this in within my calculator there. And for the prorated version for your preferred shares, you're going to have 1.301571%. So if we add all of these together, we're going to get WACC. Okay, let's go ahead and do that. Let's go ahead and add all of these bad boys together. So we have 1.0593 plus 2.02 314,672 plus 1.301571. And we're going to get the following value. And it's pretty darn close to what I have in my solution. So I'm pretty happy with that. So we're going to get a WACC of being equal to 4.3840172%. And that's going to be the weighted average cost of capital of the firm. And hooray, you're happy because we got our answer. And it's actually very close to what I had. Because on my solutions with no rounding up, I got 4.3843. That's very, very good. On an exam, you'd be on the ball. So let's take a step back though, because we did a lot of stuff here. I mean, we're 47 minutes in within this portion of the video. And congrats if you're still here. But what's awesome here is that we just had to identify the pieces of the question that we need. Because with our flowchart, we knew exactly what to do. We knew what information we had to highlight. We knew how to find our market value of equity, debt, and preferred shares. And then we knew how to find the cost of equity, debt, and preferred shares. Of course, you are required to find the price per share at times, and that's just the name of the game. But I think you're really on the right track at this point. So let's go ahead, and I know you're tired if you're still on this video, but let's go ahead and run, like literally sprint through another version of this question together. We're just going to go ahead and highlight the pieces that we need, and then I'm going to give you all of the answers one by one. It's going to make some sense. You'll see what I mean. All right. So let's go ahead and do that. Let's move on to the next one. On this call. Okay. So let's go ahead and do this. So we have now Orange Telecom, and we're going to go ahead and highlight everything bit by bit, just like how we usually do it. So Orange Telecom, if we begin, we're going to read sentence by sentence, and then we're going to highlight the stuff. Orange Telecom's common stock has 1.5 million shares outstanding with a book value of $20 per share, and it regularly pays a dividend to its shareholders. We only care about this portion here, okay? The rest for us, it's all noise. It doesn't matter. We don't care about the book value. It doesn't do anything for us, okay? We don't need that. Now, if we move on to the next sentence, they're letting you know that note that Orange Telecom just paid a $4.50 annual dividend per share, and the CEO mentioned that it is expected to grow at a rate of 2.5% per year indefinitely, so forever. So just paid a dividend of $4.50 is amazing. A growth rate of 2.5% is exactly what we care about. That's going to happen forever, because that's information that we could plug in within our common growth, our constant growth DDM formula, my bad. Then we also, if we read the next sentence, we have their common stock has a beta of 2.15, while the standard deviation on the market portfolio trends towards 10.45%, while its annualized returns yields 7.5%. Let's go ahead and highlight the stuff that we need. Common stock has a beta of 2.15. That's exactly what we need for our cost of equity. The deviation, blah, 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 we don't care. What we do care about is the returns on the market portfolio, which is 7.5%. And they tell you that the risk-free is 2%. All right, so we have a bunch of information that we need. Now we're also going to jump into the third bucket of our WACC, which is the preferred shares portion. In this case, they're letting you know that there's 1 million preferred shares outstanding, okay, with a face value of $100. Surprisingly, the preferred shares are trading at 115%, while the preferred rate trends towards 8.5%. That's awesome news because we know they're trading at a premium, and we know that the preferred rate trends at 8.5%. And I could go ahead and maybe just highlight something for you. This means that our DPS is going to be equal to $8.5. And this means that our price here is $115. So just like that, you could find K in a second. Now, this is where it gets interesting. We're going to look at our section dedicated to our bonds, dedicated to our actual debt, our long-term debt. So however, Orange Telecom's capital structure holds traditional long-term debt in the form of 15-year semi-annual coupon bond with a face value of $1,000. However, this was issued 4 years ago. That's important. Let's work with that. Let's go ahead and kind of highlight everything here. Traditional long-term debt, that's good. So we're dealing with the debt portion. That's why this is being highlighted in orange. And it has 15 years, okay? It's a 15-year bond with semi-annual coupons, all right? And a face value, sorry about that, of $1,000. However, these were issued 4 years ago. If they're issued 4 years ago, what does that mean for you? Well, it means that this is no longer a 15-year bond in like your respect. In your respect, you're only gonna get 11 years worth of coupons here. So technically, your number of years is equal to 11 because you're gonna do 15 minus 4. And because we know we have 2 payments per year, you're gonna have essentially n being equal to 22. So just some quick game, all right? And of course, frequency in this case is 2. F is equal to 1,000. Okay? The firm issued 275,000 bonds with a coupon rate of 3.25%, while the annualized yield to market, so the annual YTM, is 4.85%. Notice how the market rate is larger than the coupon rate, and this means that this bond, okay, is going to be issued at a discount. That said, let's highlight the stuff that we need. So we have 275,000 bonds, all right, a coupon rate of 3.25%. And then we know that the yield per year is 4.85. And with that, you could also note that our corporate tax rate is 35%. We know that the firm what we're solving for is WACC. So now that we have all this information, I tried to run through it. Maybe that was too slow. We're going to go ahead and solve for every single one of these buckets, equity, debt, and preferred shares, in order to find the cost of all of these and the market value of all of these, okay? We're gonna do it quickly though. So you'll see how much fun you're gonna have here. So let's go ahead and do this. If we look at the first step, which is solving for the cost of equity, in the question, they gave us everything that you need, right? They told you, okay, well, RF is 2%, beta is 2.15, and the market return on the market is 7.5%. So if you were to go plug that into your formula, I guess we'll keep this as a standard blue. I'll make it simpler. We're going to have KE is equal to 2% plus 2.15 times 7.5%. This is going to give you a KE of underscore. Oh, my bad. That's just on me. I'm tripping a little bit. This is market risk premium. We're just going to plug that in instead. This will be easier for us. It's 5.5. And if you plug all of that some good stuff in, you're going to get a cost of equity of 13.83%. All right, so that's awesome news. Now, if we go ahead and remember from our question, we know what's our recent dividend, we know what's our growth rate, and we know what's our cost of equity now. Our cost of equity is going to be 13.83%. We know that our growth rate, it should be like 2.5% if I recall. Yes, it is. And we know that our recent dividend is equal to 4.5. So if you plug all that good stuff in, right, within our formula, because we have our DO, we have our G, we have our K, and we have our minus G, we're going to be able to solve for our present value. So you could go ahead and do that. So if you do PO is equal to 4.5 times 1.025 over 13.83% minus 2.5%, you're going to get P0 is equal to 40.73. And this is very important for us because now that we have the present value of one singular share, this is important because one, we notice that this is bigger than the book value. And two, it's going to help us solve for the actual value of our equity. So if we go ahead, we have this, that's amazing news. We could go ahead and solve for a number of, essentially our value of equity. Our value of equity here, we're going to look at how many shares we have outstanding. In this case, it's 1.5 million. That times 40.73 is going to give us the following amount. It's going to give us a value of equity. Go ahead, I guess, and write this like that. We're going to say that equity is equal to 61,2,715.23. And you can notice that this is all correct. All right, some quick math. Now that we have that, we could go ahead and move on to solving for our cost of debt. Our cost of debt is going to be a walk in the park because now we understand and we've internalized that this is simply our effective annual rate formula, which we're taking our quoted rate, dividing it by the frequency to the power of the frequency minus 1. In this case, we know that we're going to take 4.85% divided by our frequency, which is 2. So we have 2 here, 4.85%. And we're going to get our answer. So KD is equal to 1. I can't even do basic math in my head right now, but I'm going to say 4.85%. That's like 42.5. Should be something like that. The power of 2 minus 1. That should give us a KD. If I plug it in here, that's going to be equal to the following. So that's going to be our KD. And notice how that's exactly the correct amount. So I'm working it with you quickly, right? That's how fast you want to be on the exam. So now that we have our face value, my bad. We're solving for present value of the bond. And we know that because it's not issued at par, our coupon rate's not equal to our market rate, we understand that we're going to have a bond at a discount. So what we're going to do here is we're going to identify everything. We know that we have 1,000 for our face value. We know that our coupon, right? Our coupon payment here, rather, we could go ahead and find it pretty effectively. What we're going to do is we're going to do 3.25% times 1,000. Then we're going to divide that by 2. We're going to get 32.5 divided by 2. We're going to get $16.25. Now here, they kind of like rounded it down there, but don't you worry. And our yield to maturity was 3.25 divided by 2. Okay, 3.25 divided by 2. You're going to get essentially my bad, 4.85, my bad. This one, 4.85 divided by 2. You're going to get this amount here. Our number of periods would be 22. So notice how everything that we have here is correct. Now this is rounded up, this is rounded down. And we could go ahead and plug this in within our formula. So PO be equal to 16.25 over 0.02425, 1 minus 1.02425, power of 22, 1. And then I could do this plus 1,000 over 1.02425, 22. And that should be pretty good. I don't think there's any mistakes. Such that we would have P0 is equal to 274.55, that's part A, plus 590.29. You would get that your P0 is equal to 864.84. Yep, that's okay for me. And that would be the price of one singular bond. And that kind of makes sense, right? Because we have a bond that's issued at a discount. Now that we have that, we need to go back to our question and we understand that there is 275,000 bonds outstanding, and we know that this is going to be our price per bond. So then it becomes easy to solve for our value. For debt, it's going to be 275,000 multiplied by 864.84. That's going to give us debt, such that debt is equal to 237,830,824.65. And we're almost done. Now we're at the last step. We're going to solve for our preferred shares. And by the way, notice how this is correct. Okay? Yeah, quick sense check. So now we're at the preferred shares section. Now the first thing that I'd like to do for our preferred shares is we could go ahead and kind of solve for our cost of preferred shares because we did it previously. So we're going to go ahead and do that. We know that DPS is going to be equal to, what was it, 8.5% times 100, such that our dividend is going to be equal to $8.5 per preferred share. Now we also need to find our P0. So I guess we're going to have to go up to the first step. That's on me, my bad. What you're going to do here though, P0 is going to be equal to 100 times 115%. That's going to give you $115. Now that you have that, you could go ahead and say, well, you know what? Our KP is going to be equal to 8.5 divided by 115, such that our KP, I'll go ahead and highlight this as our P0, such that our KP is going to be equal to, if I could do some quick math, 7.39130. 7.39130. That's going to be our essentially our cost per shares. So now we're stoked. We just need to recall one last thing, which is how many preferred shares do we have outstanding? In this case, our preferred shares outstanding, so I should write it here, is 1 million. And we know that it's trading at 115 each. So what you're going to do is 1 million times 115. You're going to get $115 million. So that's awesome. So now we have every single thing we need to solve for our value of the firm. We have our equity value, our market value of equity, we have our market value of debt, and we have our market value of preferred shares. So we could go ahead and zoom in and go to the bottom of the page. We could go ahead and solve for V. So I guess I'll zoom in a little bit more just because why not? Let's actually be kind of comprehensive here. So we're going to have V as being equal to, in this case, our stuff, I'll do this actually. Yeah, make this nicer for y'all. There you go. We're gonna have V is equal to E plus D plus P. In this case, our value will be equal to 61.092. Oh, I'll just write it out as a whole. Plus our debt of 237,830,825. Plus our preferred shares of 115 million. And we're going to get V is equal to 413,923,540. This is awesome news because now that we have our value for the firm, we could go ahead and solve for our actual, essentially, percentage, so our E over V, our D over V, and our P over V. So for our E over V, what we could go ahead and do is we're going to put our equity over the value of the firm, so 61,092,715 over 413,923,540. That's going to give us 14.76%. Now let's look at the market value of debt. For the market value of debt, you're going to have 237,830,825 divided by 413,923,540. And that's going to give you 57.46%. Now, if we look at our preferred shares, for I guess the proportion allocated to P over V, you could find a reminder. So you could do 100% minus 57.46% minus 14.76%, and that's going to give you the answer. Or you could simply do 115 million divided by 413,923,540. That's going to give you 27.78%. Okay. The reason why we need this, I hope it's clear, is because we need to plug that in within our formula. Okay. So I'm gonna go ahead and highlight these in their respective colors such that it's kind of like straightforward for you afterwards. So now that we have that, we could go ahead, plug that in within our formula with all the information that we had previously. So we're almost done. Okay. So our cost of equity, what is it again? Well, our cost of equity is equal to 13.83%. Our equity over value is going to be equal to 14.76%. If we look at our cost of debt, well, our cost of debt is going to be equal to 4.91%. And our tax rate, which we already know, is going to be equal to 35%. And our debt over value is going to be equal to 57.46%. So right now what we're doing is we're just taking back all of the information we had at the very beginning of the question. Now for our cost of preferred shares, I'm going to round it up again just because I'm a lazy man. We're going to have, what was it again? It was 7.39%. And for a preferred value, or preferred market value preferred shares over the value of the firm, we're going to have 27.78%. By the way, I'm sorry if I'm not as hyped and as excited. It's not because I'm like, you know, in any bad mood or whatever. It's just because, damn, it's so nice outside right now. And I want to eat and I want to finish this because I feel like you know what to do by now. So I guess it's a bad excuse to just say my bad if I'm not being as energetic, okay? But what we're gonna do now, because it's the last step, we're gonna work as a team and we're gonna find the value of our prorated cost of equity, then the value of our prorated cost of debt, and the value of our prorated cost of preferred shares. And then we're gonna find every single one of them, we're gonna add them up together, and that's gonna give us our WACC, like what we did in the previous question. Let's go ahead and do that. So we're gonna have here 13.83% plus 14.76%. I mean, multiply, sorry. And we're going to get, it's okay. We're going to get 2%, 0.041308. So I'm going to go ahead and write that. Now we could go look at our cost of debt. Our cost of debt will be 4.91% times 1 minus 0.35 times 57.46%. Just always making sure that my stuff is inputted correctly. I don't want to give you all any mistakes. So we're going to have one, as our output is going to be 1.8338. 3.59%. And now finally, last but not least, or low-key kind of least, we're going to do the same thing, but for our preferred shares. So we're going to have 7.39% times 27.78%. Okay? And what are we going to get? We're going to get 2.0529 or 2.0529 4.2%. So now, for all the marbles, you hear the choir singing or the fat lady singing. I mean, I don't want to objectify anybody. Maybe that's rude. My bad. It's a saying that I used to watch back in the days when I used to watch Chris Move play Modern Warfare 3, and he would get like those Moabs. Anyways, I'm just giving you context, being sincere. But you hear the music going. You know, this is where the magic happens. We're gonna add all of these together. So let's go ahead and do that. Oh man, I need some sleep. So 2.041308 plus 1.83383. 9. I'm so not good at writing numbers. Well, it's like a basic skill. Someone got it. I don't have it. And that should give us 5. And I may be off by a little bit, but it's okay. We're good with that. It's going to give you a WACC. I may have put a wrong thing. It's whatever. I'm okay with that. I'm going to sleep at night. We're going to have 5.9280859%. Now, depending on how much rounding you did along the way, you may get something that's slightly different. But really the core of this answer, it relies on the 5.92.8.7. So you could really round this up to being equal to 5.93%, which would be the WACC of the firm. Okay? And that's really how we go about this. After an hour and 33 minutes of walking through this very easy concept that we found a way in finance to make it more complicated. But all jokes aside, the skills that we talked about in this question are actually going to apply in several different chapters. Being able to walk through the market value and the cost of any given portion, equity, debt, or preferred shares is something that you will very much need within a final exam, very much need within a final project or assessment. And these skills are going to carry forward towards future finance courses you will take in your major during your undergrad, especially if you're somebody trying to get a sense of some materials before entering their MBA or their master's. Understanding how to walk through this is also very crucial. And hopefully in this video, you're able to kind of come out of it with some sort of confidence, knowing how to break down these questions into pieces. And for sure, I mean, the last one I ran through it, but it definitely does get easier. Okay, so if you want more material on this, if you want to feel more empowered, you can definitely go on my website at ismahelps.com, and you're going to find not only some interactive problems on WACC, but you're also going to find a plethora of questions ranging from basic introductory ones all the way to very complex ones like this. And if you go on my YouTube channel, you're going to find other videos with an idiot like me explaining things to you. All jokes aside, I really think that hopefully this could be like a solid step towards you feeling more empowered. towards you feeling like you have resources that are not static, that are actually there to help you, that are going to give you a comprehensive view on these topics. And maybe, just maybe, I could be somebody that's actually a little bit more fun to deal with when dealing with these concepts. So hopefully that's maybe not the solution, but hopefully it's like one step towards that solution. And I'm literally so happy to help in any way I can to make an amendment, to change, to make adjustments, to help you guys and girls and everybody in between or whatever, right? To help y'all kind of make it towards that end. And that's a sincere mission of mine. In Japanese, we would say, watashi no shime wa. So my mission is, watashi no shime wa, 大学生でたくさんは something like that. My Japanese still isn't that great, but anyways, all jokes aside, you're amazing. You're a superhero or whatever you want to call yourself. You're super great and you can do this. And yeah, hopefully this helped you out. This was 1 hour and 36 minutes of absolute nonsense that hopefully empowered you and gave you the opportunity to go into your exams head high and understand that you could own this stuff. So definitely add this into your formula sheet if you can and study. Okay, bye-bye. See you next time.